Texas Insurance Training Academy, Property and Casualty Initial Licensing, Chapter 5. We're going to be talking about property policies here in this chapter. So Chapter 5 is going to go on first-party coverages for both personal lines, which are for individual needs, and commercial lines for business needs. Some common conditions, provisions, and exclusions for property policies. The policy period is going to be effective during the initial or effective date of the policy all the way through the expiration date of the policy. Typically, these will be set at 12:01 a.m. on the effective date and end on 12:01 a.m. of the expiration date. One concept on the property policies is that you are not able to have a policy that has an insurable interest greater than your amount of ownership in the property. So you have a limit on there. If you had 3 different people that owned a property for $90,000, each of them would only be able to get $30,000 worth of insurance if they were equal owners of that property. Duties after a loss. So these are conditions for property policies that have to be met. For all property policies, you must promptly report the loss to the insurance company. If the loss is due to theft, from a peril of theft, you have to notify the police. If there is a possibility of a credit card or fund transfer company involved in the potential payout on that, you will have to notify them as well. You do have to protect the property from further damage and make reasonable repairs. This would be like trying to, after a hailstorm had created a hole in the roof, you would be able to go up there and put a tarp with some bricks holding it down so further water didn't get in there to damage more. And just as long as you've made those reasonable repairs, the insurance company will pay you back for that. It won't come out of your little limits on there. And this satisfies the condition of a duty after a loss. You must also allow the insurance company to inspect the property, and if asked by the insurance company, you must submit to an examination under oath. Always you will have to send out a signed sworn proof of loss to the insurance company within 91 days in the state of Texas. Most states are going to be 60 days. If you take a lawsuit against the insurer on a property policy, you have a time frame of 2 years and 1 day from the date of the loss. For pairs and sets for property policies, the insurer has the option to elect to either repair or replace or pay the loss of the difference in the appraised value of the set or pair. An example of this would be an insured has 12 antique dishes appraised at $1,200. One was damaged and a covered loss. The appraisal for the 11 dishes is $800. Then what would the insured's loss be? A, $100, B, $0, C, $400, or D, $200. So there's nothing special here. It's just the difference between what it was worth before and what it is worth now. $1,200 minus $800, so this would be $400. It is required for the insurance company to declare their option to either repair or replace within 30 days of the submission of the proof of loss from the insured. And loss payment is within 60 days of the proof of loss agreement or other award to the insured. Now, in the event of catastrophic losses such as hailstorms, tornadoes, hurricanes, they can't extend this out for good cause. Loss valuation is going to be generally the lesser of by the insurer, meaning that they will pay the least that they can get away with paying legally. And it's going to be what the insured property is valued at the time of the loss. Now, if you have a situation where the cost to repair or replace is more than the property's actual cash value, which we'll define here in a second, this would be defined as a total loss. And any loss that is not a total loss is defined as a partial loss. Actual cash value is going to be equal to the replacement cost of the item minus its time value depreciation. So what this means is that typically certain items will last you for 10 years. If that's the case, each year it will depreciate by 10% of its value. So when you take a calculation like this, you can take something like a television that does actually decrease in value for replacement costs over time, because the new models come out and the original technology that was there becomes less expensive because it's more obsolete. So an example would be if you bought a 60-inch TV for $3,000 5 years ago, that same TV only costs $1,000 to replace today. Not the updated model, but the original model. And we see this all the time. On a 10-year life expectancy, it will decrease 10% per year. There is no standard on these necessarily, but 10 years is kind of a good rule of thumb for a lot of personal property. All right, so you would expect the TV to last you 10 years. So therefore, it's going to lose 10% of its value every year. So if you look at the actual cash value for that TV, as far as insurance would look at it, it would be $1,000 for the replacement cost, which is how much it costs to replace today, minus 50% for the depreciation, which means the actual cash value of that TV is only going to be $500. Now, the same type of thing can happen when the value goes up. In this case, this is something we have seen lately for furniture. A sofa that was purchased for $3,000 5 years ago, now that same sofa costs $5,000 to replace. This couch is supposed to have the same amount of life expectancy as the TV, so 10 years, so it'll depreciate at 10% per year. So if you look at the actual cash value of this couch, what we're looking at is $5,000 is today's replacement cost minus the 50% depreciation. So therefore, the couch actual cash value would be $2,500 for insurance purposes. Understand replacement cost is defined as the cost to replace damaged property with like, kind, and quality at today's price, today's cost, not the original cost. Technically, or this would be contrary to the principle of indemnity, but that doesn't mean that the insurance companies don't use it all the time, because this is what their customers are asking for. They kind of bake it into the pricing and the premium so that they can do that. Different types of valuations are going to be possibly available on a property policy. Market value is one, but it is extremely rarely used. And the reason for that is that it sets up an argument from the beginning. It's the value that a willing buyer would pay at the time of a loss. So this one typically is going to be very difficult to do, and you're already probably going to go into an appraisal type situation. Because you're already not agreeing on the type of the pricing for it. Agreed value, this is typically used in commercial property policies. This allows for a suspension of the insurance to value clause using a statement of values. Basically what this means is, as you can have an expedited process to get commercial property without having to go get an appraisal on a building first, for example, you wouldn't necessarily know the exact value of it, so it's not going to have a requirement in there. And we're going to talk about the insurance to value clause here in a minute. But typically it's going to be at least 80% of the value of the property. So they suspend that until they've actually received any kind of an appraisal, or update the policy by doing an audit, which is where we talked about deposit premium and audit previously. Stated value, this is usually used for special situations like unique, antique, or customized automobiles. The stated value is used because it has a method of how they compute the premium. It's not necessarily how they're going to pay out losses there, because these situations have difficult to evaluate actual cash value, because there can be a high variance in the cost of replacement parts or labor to work on certain things, depending on what type of situation you're dealing with. And then salvage value is going to be used in a situation where there is a total loss of the vehicle. In this case, salvage value is going to be automatically applied in there unless you ask for it to not be, because what will happen is they'll give you not only the actual cash value of the vehicle, but they'll add in the amount of money that they can recoup from scrapping out the remaining vehicle parts and pieces, so that they can keep the greatest amount of value there, right? So in this case, you would have to surrender the title so that they can do that. Otherwise, you can keep the title, get a lesser payment, and you would have to then be responsible for doing the scrapping out yourself. A deductible, this is going to be something that I hope that everybody probably already knows at this point, but a deductible is most of the insurers obligated to pay is everything minus the deductible. So sometimes the deductible is called a retention. And the higher the deductible means that you're going to have a lower premium, and you're also going to have a high premium, typically with a lower deductible. Now we get to talk about the coinsurance and insurance to value clause here. What happens here is that there is a situation in which some insureds decide that they don't want to keep the proper amount of insurance on the policy. So they're not keeping the replacement cost value amount there. So this allows for owners to reduce the amount that they are covering on the policy less than the replacement cost value. But what this does is it puts a line in the sand to where if you don't have the proper amount of insurance as determined by the coinsurance for the property, you will end up having to suffer a penalty on any partial losses on that property. So what we're talking about is, let's just say you've got a replacement cost value of $200,000 for a house. And the $200,000 is how much you should have on there so that if the thing completely burnt down, that you would be able to replace and rebuild that house. But the insurance company typically is going to put down a 80% coinsurance ratio on there, meaning that you're going to have to keep at least $160,000 of insurance on the property. Otherwise, any partial loss would be subject to this next formula that we're going to discuss. Now, to determine how much insurance you should have had on there, you just multiply the replacement cost value times the coinsurance. It's just a multiplication. 80% times the 200,000 gets you the 160,000. So the formula to reduce the payment in the case where the amount of insurance that you did keep on the policy is less than the amount that you should have, you would take the amount of insurance that you did keep on the policy divided by the amount of insurance that you should have kept on the policy, multiply that by the loss, and of course subtract out the deductible, and that would be the payment in the case of a partial loss where your amount of insurance was less than what you should have had on the policy. So an example that we have here is going to be John owning a home with a replacement cost of $100,000 for which he did insure it for $40,000 with a $1,000 deductible and an 80% coinsurance clause. He suffers a $40,000 loss. They're asking in this case, how much will he be paid? Well, of course, he can't be paid out $40,000, even though that is the maximum amount of insurance that he's got on there, because this is a partial loss and they will suffer a penalty in this case. So the first thing we do is we take the $100,000 times the 80% to create what we should have had on the insurance. So that we calculate the should first, and this comes out to $80,000. Now we take the $40,000 divided by the $80,000. We multiply that by the $40,000 loss and subtract out $1,000, which down will calculate out to $19,000 of payment to John in this loss situation. Second example here, just so you know, if there was a total loss on that case, $100,000 would be the loss, but the amount paid out would be the maximum that could be paid out. So a total loss would be up to the maximum, which would pay out to $40,000. Now, question 5, the insured purchased $100,000 of insurance on a building with a replacement cost of $250,000. The policy has a minimum co-insurance of 80% requirement and a $1,000 deductible. If the insured had a $120,000 loss, how much will the company pay? So this is not the proper amount of insurance, but we can figure that out real quick. How much insurance should this insured have had? You would take the $250,000 times the 80%, which comes out to $200,000. And clearly, the $100,000 is not equal to $200,000, it's much less, and therefore you would take and apply the formula. So $100,000 divided by $200,000 for the did and the should, multiplied by the loss of $120,000 minus the $1,000 deductible. In this case, $59,000 is what it comes out to, and that's answer C. One thing to note about all property policies is that these property policies will have no benefit to a bailee. That's somebody that has property in another's care, custody, or control. Typically, bailee coverage or exposure is going to be associated with a situation where you've got, a business need, right? So a lot of examples of bailees are going to be dry cleaners, repair shops of, shoes, autos, whatever it is, TVs. So you're basically having something held for a special purpose and then returned. And while it's in your care, custody, and control, if something happens to it, you're responsible for it. That's where you would need bailee coverage. And there is no benefit to a bailee in property policies. So it is excluded. Cancellation on all property policies is going to be requiring a 10-day written notice within the first 60 days of underwriting, and then all other reasons why you would potentially have a middle of the term insurance company dropping your policy or canceling your policy would be things like if there was any fraud, or if there was an increase in the hazard, or if the insurance company was having financial troubles with either reinsurance or becoming financially impaired, because the Texas Department of Insurance will require it. Also, on a non-renewal, if the insurance company doesn't want to renew your property policy, they will have to give you a 30-day notice prior to that non-renewal. Now, if the insurance company decides that they want to do something that is better for the insured, they are not required to physically change the policy if it's to the betterment of the insured. This is through what we call the liberalization clause, so they can automatically apply this to the policy without having to physically endorse to the policy. The death of a insured under a property policy does not stop the policy. In this case, the legal representative becomes an insured so that the property can be properly adjudicated after the person's death. Endorsements are going to be any written waiver or change of a policy provision. These are going to have to be done in writing by the insurer, typically by an underwriter. In property policies, there is a possibility that you have some of your property stolen, and you do have, as the insured, what we call the recovered property option. That means that if the insurer has already paid you out a payment, you have the option to take the property back or keep the money that they gave you. In the case that you keep the money, they just have to have you sign over ownership or title to the property. And in the case that you take the property back, you have to return the money, right? Obviously, you can't do both. One thing here under the mortgage clause, just understand that nothing that the insured does in this case will impair the rights of the mortgagee, and the mortgagee will have the same rights as the insured, right? So an example here would be the insured borrowed money to purchase a building and then tried to set it on fire to collect the insurance, but the arson was discovered and the claim was denied. But the mortgagee, the bank, right, will still be paid what it was owed, right? So just because there was something illegal there and they couldn't pay that out doesn't mean that the bank cannot be recompensed in that situation. Loss payable clause is going to be something that also is something out there for if the declarations page is showing a loss payee, they will be considered an insured, and therefore they're going to require a notice of cancellation or non-renewal. Concept that we need to understand here that comes up on the test periodically is liquidated demand. This is in the case of a total loss by only the single peril of fire. So it has to be a total loss by fire only. In these cases, these policies do not suffer a deductible, right? So the full amount of coverage is paid out and no deductible is applied. Another name for this would be called a valued policy. All right, some exclusions on the property policies. So the first one's going to be what we call ordinance or law. Typically, this applies to what we call building codes, right? So if you say had a building that was built back in the 30s, that was before insulated electrical wire was used, they would call that 3-wire. These are exposed wires, and new laws require that those be updated to insulated wires for fire safety hazards. And so because of that, that can be a pretty significant increase in cost. But these things can happen all the time. But generally, property policies will exclude the ordinance or law updates, and they will only compensate you back to the actual cost. They won't pay for the upgrades or the new updates to the building code updates there. Also, typically, the property policies will not cover earth movement. This includes land shock waves, earthquakes associated with either volcanic action or landslides, mudslow, sinking, rising, shifting, mudslides, or sinkholes. Water damage is also typically not covered under property policies. This is including damage caused by flood, sewer backup, or other types of water damage. Now, under both earth movement and water damage, just because these are typically excluded under property policies as a standard doesn't mean that they can't be changed here. There are common endorsements that you can get for earthquake and for flood and sewer backup that you can put onto a policy to have those things covered. Power failure in this case is going to be defined as as any utility service that occurs off-site of the location and causes damage on the property or causes some kind of a loss. That peril will not able to be covered under property policies. Generally, neglect is never going to be able to be covered under insurance, and this is because if at the time of the loss further damages because of the insured's neglecting to try and save or preserve the property, there is no coverage for the additional loss or damage. This is also reinforced under the conditions, but it's also listed under the exclusions as a separate exclusion of neglect. Governmental action is going to be excluded. This is referring to either the destruction, confiscation, or seizure of property by order of the government. The one thing that will always be covered in this case would be a fire. Nuclear hazards are too large of an exposures, as are wars, insurrections, rebellions, and revolutions. Damages due to those causes will be excluded from personal property policies, as well as commercial property policies. And of course, intentional losses. So no policies out there will cover intentional losses. There's only some limited amount of personal liability policies, professional liability policies that might cover some limited amount of intentional losses. But for the most part, if you are committing or directing another to commit an intentional act that causes the loss, unfortunately, that cannot be covered under the insurance policy. All right, so now we've got some questions. We're going to go over a review on Chapter 5. First question we got here is the insured's roof is damaged in a hailstorm. The insurance company asks the insured to cover the holes so that the rain will not get in and further damage the property. This is an example of what policy condition? A, appraisal. B, abandonment. C, duties after loss. Or D, duty to defend. So of course this is going to be under the C, duties to after the loss. Number 2, which of the following statements about a mortgagee's rights under a property form is not correct? So 3 of these should be correct, 1 should not be correct. A, no act by the insured will jeopardize the mortgagee's rights. B, the mortgagee may file a proof of loss if the insured fails to do so. C, the insured is mortgagee is entitled to the prior notice of a policy cancellation. Or D, the mortgagee may abandon the insured property to the insurance company. Well, the insured can't do this, neither can the mortgagee. D, the mortgagee cannot abandon the insured's property to the insurance company. Number 3, Bob is purchasing a homeowner's policy to cover a home costing $200,000 to rebuild. The policy contains an 80% coinsurance clause. In order to avoid the coinsurance penalty in the event of a partial loss, Bob should purchase the policy with minimum limits of at least how much? A, $200,000, B, $180,000, C, $160,000, or D, $40,000. So in this case, we are just asked to calculate the should, how much insurance should Bob have? And in this case, it's 80% times 200,000, which is C, $160,000. Number 4, one of a set of a dozen antique crystal glasses was damaged in a covered loss. The set had been valued at $1,800, but now are only worth half of that. How much was the loss? A, $150, B, $600, C, $400, or D, $900. In this case, half of $1,800 is $900. That's going to be the value, but also the loss. And they're asking for the loss. This is D, $900. Number 5, how much time does an insured have to bring a suit against his insurance company in the state of Texas after meeting all the policy conditions? Is it A, 1 year, B, 2 years, C, 3 years and a day, or D, 2 years and a day? The correct time frame here is D, 2 years and a day. Number 6, actual cash value is defined as A, what you can sell it for, B, what you can buy it for, C, what it is worth after depreciation is taken from what it costs today, or D, what it is worth after an appraisal. The definition of actual cash value is C, what it is worth after depreciation is taken from what it costs today. Number 7, how soon after the proof of loss is filed with the insurance company in Texas must it pay you? A, 60 days, B, 30 days, C, 15 days, or D, 91 days. So in Texas, this is going to be A, 60 days. For the dwelling, number 8, liquidated demand provision requires the insurer do what? A, to pay the full face value of the policy in the event of a total loss. B, to pay the claim when the insured demands it. C, to pay the full amount of the policy for a windstorm loss. Or D, to pay the total amount of the insured on the structure for a total fire loss. The answer here is going to be D, to pay the total amount of insured on the structure for a total fire loss, right? Remember, total loss due to the peril of fire only for liquidated demand. Number 9, Dora insured her home for $50,000, even though the cost to replace is $250,000. She suffered a $40,000 fire loss, and she has an 80% coinsurance requirement. How much will the insurer pay Dora, assuming that no deductible applies? So first, we have to factor in what is the amount of insurance that she should have had on there. So this is going to be $250,000 times 80%, which is $200,000. The did in this case is $50,000 divided by that $200,000, which is going to be 1/4 or 25%. And that is going to be multiplied against the $40,000 fire loss, which is $10,000. And since in this case, they're asking you not to apply any deductible, there would be 0 there. So the payout in theory to Dora would be $10,000 C. Number 10, when a regulating authority requires the damaged property be replaced at a new building code standard, which increases the original cost, these costs are excluded. What is the name of the exclusion? A, replacement value or law, B, an ordinance or law, C, actual cash value or law, or D, ordinance or codes. In this case, the correct answer is going to be B, ordinance or law. That is the correct name for that exclusion. That concludes Chapter 5, Property Policies. Now we're moving on to Chapter 6, Dwelling Policies. Dwelling policies are considered personal lines and are written on a single policy basis called monoline. The reason that people will buy dwelling policies is because they cannot qualify for a homeowner's policy due to an age, value, location, or condition issue with the property. There are 3 types of insureds that will have an insurable interest in a dwelling policy. 1 would be an owner, number 2 would be a landlord, and number 3 would be a tenant or renter. These policies have certain eligibilities, can insure either the dwelling only, the personal property only, or both. There are 3 separate coverage forms that will cover dwelling policies, and you need to know the term as well as the code that goes with this, if you will. So basic is going to be your most simple coverage on a dwelling policy, and it's going to be abbreviated with a DP-1, DP standing for dwelling policy. The second tier here, and this is getting better coverage as we go up, broad coverage under a DP2 form, and then special coverage under a DP3 form. So the types of properties that can be included in a dwelling policy property form would be up to 5 roomers and boarders, up to 4 residential units under one roof, up to a quadplex. Any properties under construction, either owner occupied, tenant occupied, or both. Mobile homes can be covered under a dwelling policy, but only under a DP1 coverage form, and only if the axles and wheels are removed and it's on a permanent foundation. Seasonal dwellings also can be on there if they're unoccupied for 3 or more months out of a 12-month period. Farms are not able to be covered under a dwelling policy, nor are they covered under a homeowner policy because they have special exposures due to the business aspects of the farm. Now, speaking of business, under a dwelling policy, you can have a business operating out of the dwelling, but only if it's considered to be incidental, right? So incidental businesses are going to be conducted by the insured on the dwelling premises, and if there are no more than 2 employees working at any time. Permissible types of incidental occupancies are going to include barber and beauty shops, tailor, shoe repairs, professional offices like insurance agents, private schools, studios, music or photography. All these things would be considered as incidental type businesses. Now let's talk about the different types of forms. We're going to talk about the standard basic form first, which is the original coverage that you would get. The least expensive option you have for any property policy is going to be a basic DP1 standard form. In this case, just so you know, in all DP1, it is only going to be on those specifically named perils only is the only coverage you're going to have, and the valuation for loss is going to be on an actual cash value basis. So the 3 perils that you will, or causes of loss that you will have coverage for on the dwelling policy are going to be fire, lightning, and internal explosion. An internal explosion is like the explosion of a gas water heater inside of a house. Okay? So those 3 things are the only things that are covered under a standard DP1 policy. Now you can choose option 1, which is an endorsement that allows for additional perils to be covered under the policy. In addition to the standard perils, the 3 perils, you will get what we call the 9 extended coverage perils. Now there is an acronym CHS waiver that may help you as far as trying to understand what is covered under these, for remembering these. Sometimes that helps people, sometimes it doesn't. So the additional things that will be covered by the option 1 are going to be windstorm and hail. So this will cover any damage due to windstorm or hail, and then any damage to the interior of the building if the exterior was damaged first. Right? Understand, under windstorm and hail, there is no coverage applying to rowboats or canoes in this case, even though there can be some coverage for those under personal property. The second one is going to be explosion. Now, instead of just an internal explosion, external explosions are going to be included. An example of an external explosion would be there was a fertilizer plant in the city of West Texas that went through an explosion, and the percussion wave damaged properties up to 17 miles away from that plant. Riot or civil commotions, the next one. This includes damages by the people that have been assembling or protesting, like the election of President Trump back in 2016 or 17. You can also include in there Black Lives Matter, if you want to look at an example on both sides of the political spectrum. Aircraft is going to be the next one. Aircraft is going to include any self-propelled missiles or spacecraft, anything that comes off an aircraft, or anything that, like, say, Elon Musk is doing. Recently, he had a rocket explode that was supposed to be preparing for, I think, going Mars. But it exploded in the sky, and shrapnel came down all over the different places. I think some of it actually landed in the Turks and Caicos. Vehicles damage will be covered, but you need to be understanding that under a DP1 option 1, vehicles driven under all dwelling policies by a resident are not going to have any coverage for that, right? So first party damages from a vehicle damage under a dwelling policy will not be covered. Also under DP1 option 1, this will only cover damage to the main or unattached structure under coverage B. This will not have any coverage for damage to fences, driveways, or walkways caused by a vehicle, even if it's not by a insured. Smoke is the next thing that's going to be covered here. There will be coverage for sudden and accidental damage caused by smoke will be covered, but no coverage for agricultural smudging, industrial operations, or under DP1 option 1 coverage for smoke from fireplaces. So what would be covered in this case, say there was a fire in the kitchen that got out of control, you were able to contain the fire damage, but the smoke damage was pretty intensive. That would be a covered peril under this policy. Number 2, the last one here is going to be for volcanic eruption. This is a mudslide caused by a volcano is covered, but there would be no coverage for the earthquake, land shock waves, or tremors, aka the shaking of the ground. So those are the 9 extended coverage perils, and that would be inclusive of the standard 3 under option 1. And if you do choose that option 1 package, you can choose for an additional amount of money or additional endorsement, you can choose option 2, which adds everything that you had in option 1, which includes all the standard perils, but it will also include one additional peril, which is called vandalism and malicious mischief. This one will cover damage or loss to the property from willful and malicious destruction of the insured's property. Right, so maybe you put up the wrong political sign or something along those lines, and somebody decided to destroy your place because of it, and this would be able to be covering in that situation. This happens to be one of those policy perils that will not be able to be covered in the case of a vacancy. So if the vacancy condition is met, no people or property for 60 or more days, VMM peril will not be able to be paid out. There's a chart there on the top of page 71 that will be able to kind of help you sort out and remember which perils are covered under which sections of our DP1 basic form. So going up the ladder for broad form DP2, this is also named perils only, but for the structure, it will be replacement cost value if the policy has been kept to the insurance to value ratio that we just went over in the last chapter. Additional perils that will be covered here over the basic perils that are covered under DP1 are going to be damaged by burglars. This peril will be suspended in the case of a vacancy. Falling objects, so that the damage to the interior of the building is covered only if the roof or an outside wall was damaged first. This has coverage for collapse for the weight of snow, ice, and sleet. This also will add for people in this case. And then you're going to have accidental discharge or overflow of water or steam. Sudden accidental tearing apart, cracking, burning, or bulging. Both of those kind of refer to systems that are either under heat or pressure, like sprinkler systems or boiler systems or HVAC, right? Any of those that have not a gradual, but an explosive or an immediate or quick degradation, those would be perils that would be covered under this broad form. You will have freezing covered under a broad form DP2. Freezing is going to be covered, but it is conditional coverage. So it does require that the insured either has taken reasonable care to maintain the heat in the building or has had the water shut off and drained the pipes and appliances. In this case, just understand that freezing is not affected by vacancy. So just as long as you've got those other conditions taken care of, you will still have coverage for freezing. Artificial electric current arcs, so basically artificial lightning, it happens. That's going to be covered here under a DP2. And then you do get upgraded vehicle and smoke coverage here on DP2. So vehicles now will cover the damage to walkways, driveways, and fences driven by somebody other than an insured. And smoke from fireplaces are now covered under a DP2. Now, the last form here is the special form DP3. This is an open perils form, which means that it covers everything on the dwelling or other structure on an open perils basis, except for those that are specifically excluded, right? So the insured's personal property is going to be covered for a broad name perils value, that the same perils that you saw in DP2. And it will also contain an insurance to value clause there for any of the lost payouts, but on the personal property, it will be at actual cash value. Primary difference between the DP2 and the DP3 is that theft of property that is part of the dwelling or other structures is covered in the special form. So if somebody takes attached windows, doors from the property, just as long as it's not a property that's in construction, so it has to be physically attached to the property and stolen there, then it would be covered in that case. Or theft of personal property of an owner or occupied dwelling can be added by an endorsement. So what's not going to be covered here? So you're going to have collapse other than what we talked about in DP2 is not going to be covered. Insects, damage from termites or something like that. Any birds, vermin, or domestic animals, pets. Right? If your Rottweiler goes Rottweiler, eats up all the drywall, unfortunately that is not covered under a DP3. Also, any gradual or expected losses, things like wear and tear, deterioration, inherent vice, and latent defects, mechanical breakdown, smog, rust, corrosion, mold, wet, or dry rot. All those would not be able to be covered under a DP3 special form. Now, how are these forms looking like when you create a declarations page? So they're going to have 5 coverage letters associated with the different types of damages that you may have under the policy. Coverage letter A is going to be associated with the dwelling. It's going to have direct damage type only. Coverage B is going to be for other structures. This is also direct damage. Coverage C is going to be on any personal property. This is direct damage. And coverage D is going to be for fair rental value. This is an indirect damage or a consequential loss. And coverage E is also a consequential loss or indirect damage, additional living expense. So if no premium or limits are shown on the deck page, there is no coverage. Standard deductible on a dwelling policy is going to be $250. It is important to know these coverage letters. Now let's go over what each one of these does cover. Coverage A covers the dwelling that is described on the declarations page, any physically attached structures, any materials and supplies in the near vicinity of the dwelling, and any equipment or machinery that is used to service the dwelling, for example, an AC unit or a well. Right? Now understand under coverage A, both for dwelling and also on homeowners, there will be no coverage for land. Right? Land is never covered by property policies. Coverage B, what is covered here? This is anything that is separated by a clear space, and it is any other structures, which includes another legal word for that is called an appurtenant structure. The standard amount of coverage on this is going to be 10% of the coverage A limit. And this is going to cover things like detached garages, outbuildings, sheds, and fences, right? Anything separated by a clear space. Understand under a dwelling policy, you cannot have coverage under either coverage B or C for any grave markers or mausoleums. So those will not be covered. Those are excluded. Coverage C, personal property. This would be household and other personal property usual to a resident at the premise of the dwelling. Other property that is in the insured's custody and control other than renter's property. You can cover rowboats and canoes. Obviously, they won't be able to be covered by the windstorm or hail, and they cannot be covered under coverage form for a DP1. One thing that you do get under both homeowners and dwelling for personal property is they will cover your student's property while it is at the dormitory in college. What is not covered under dwelling policies at all, they're not going to cover any amount of money, securities, bills, accounts, banks, deeds, banknotes, deeds, passports, manuscripts, evidences of debt. They won't cover any animals, birds, fish, pets, any aircraft, watercraft, automobiles, any property of tenants, and also no grave markers or mausoleums. Coverage D kicks in if you are in a situation where you're renting out the property and you're no longer able to rent out the property due to a loss of coverage A, B, or C from a covered loss. There would be no separate deductible since you suffered a deductible under coverage A, B, or C. This will pay for the loss of that rental income until the repairs are done, but only for the shortest amount of time possible so that you do not lengthen this out due to a poor rental market. And understand that a lot of times, because there is no property actively there at the time until they get it rebuilt, the policy usually is expired or has been terminated. And understand that that does not stop the payments. The payments will continue to the insured regardless of whether the policy is currently active. Coverage E, this is going to be if you're not renting it out, if you're using the property. This covers any additional living expenses as an indirect or consequential loss, again, only covered if there was first damage to coverages A, B, or C. There is no deductible on it, covered additional living expense. And understand that this will pay for only the necessary increases in normal expenses. For example, the house burns down that you were staying in or trailer you were in. You have to go to a hotel room, right? It's going to cover that cost. If there's no laundry included with that room, you're going to have to pay for coin laundry. That's an additional cost, but it's not going to cover things like a mortgage or utilities, those things that continue to come in that were the same as they were before the loss. And this also continues on until the repairs are complete, only the shortest time possible. And again, the policy expiration does not stop the payments in this case. Now, there are other coverages, those that are included in the premium charge that do not come out of the limits of the insurance, but they are included with the dwelling policies. You get tenant improvements and betterments for up to 10% of the coverage C limit. You automatically will get debris removal for any loss. So there is a cost to removing all of this stuff. Even if you've got a burnt down house, you've got all the ash, and sometimes as we see out there in California right now, there's a lot of different things going on out there with toxic type things. All that stuff has a cost to remove it from your property before they can start rebuilding. And that is a cost that is picked up from the insurance company and not taken out of your limits of your coverage. They will also pay you back for any of those reasonable repairs we talked about. There's a concept called property removed. So property removed means that if you, as the insured, have moved your property from your property because you're trying to get it out of harm's way and it still becomes damaged, the coverage will still be in effect on your property where it is at its alternate location, but only for a limited amount of time. Under a DP1 policy, this is going to be a 5-day period. Under a DP2 or 3 or any homeowner policy, it's going to be a 30-day period. For those of you who have only lived in your city your whole life, you don't know because the taxes pay for the fire department to come out. But in the areas where taxes are not paying for the fire department to come out, you have rural fire departments which will charge you money to come out to put the fire out on your property. And so therefore the insurance company will pay you back for up to $500 of that charge for the fire department to come out to service your property. Additional coverage that you're going to have on here is also going to be for any lawns, trees, shrubs, and plants. But this is only going to be under DPs 2 and 3 only. DP 2 and 3 will have coverage for lawns, trees, shrubs, and plants up to $500 per lawn, tree, shrub, and plant, or up to 5% of the coverage A limit. The perils that are going to be covered are limited perils. They will always cover fire and lightning and explosion, right? Because everything is going to be covered in those situations. But this is only going to have other coverage for things like riot and civil commotion, aircraft, and vehicles not driven by the insured. Note that I didn't say anything about windstorm or hail or freezing. So those are perils that are not going to be covered in the lawn, trees, shrubs, and plant situation. So the only act of God that's going to be covered here is the lightning peril. Collapse coverage under DPs 2 and 3 is going to be in there. It's going to include broad form named perils, the weight of people, unknown decay, insect, or vermin. Selected endorsements under a home or dwelling policy is going to be, the first one's going to be a dwelling under construction. This is available when the intended occupant of the dwelling is the named insured. And as we discussed earlier, a mobile home under a DP1 form can be an endorsement that you would have. This is only given when the axles and wheels are removed and it's on a permanent foundation. If you had a detached garage with the mobile home, you would have an endorsement to the endorsement. So it's kind of a unique situation. All right, so time to review through some test questions here on the dwelling policies. Number one, the dwelling property policy can be used to insure all of the following except A, triplexes, B, rental homes, C, farms, or D, mobile homes. Because of their business use, farms are not going to be able to be covered under a dwelling policy nor under a homeowner policy. Number 2, under the DP1, an insured may insure the property for which perils. Is it going to be A, fire, lightning, and internal explosion? B, all the perils described in A plus the extended coverage perils? C, all the perils described in B plus vandalism and malicious mischief? Or D, all the perils described in C plus collapse coverage? So under a DP1, you cannot add collapse coverage. So the correct answer here is going to be C, all the perils described in B plus vandalism and malicious mischief. Number 3, which of the following forms provides open perils coverage for coverages A and B? Is this going to be A, basic, broad, and special forms, B, broad and special forms, C, special form only, or D, basic and broad forms? So the only DP form that your dwelling policy form that you're going to be able to use that's open perils for coverages A and B is going to be C, special form. Number 4, which of the following is not an extended coverage peril? Is it A, hail, B, lightning, C, riot, or D, windstorm? Well, because it's an original or the standard peril, right, basic perils that are covered, this lightning B is not going to be an extended coverage peril. All the rest of them will be. Number 5, the insured moved all of his stuff to a new residence and left the heat on in the dwelling he vacated. Which of the following losses would still be covered after more than 60 days of vacancy? A, freezing, B, damaged by burglars, C, water damage from a broken water pipe, or D, breakage of glass? In this case, freezing is the only one that's not affected by vacancy. All the rest of those will be affected by vacancy, and freezing will be covered because you met the condition of taking the care to keep the heat on in the property. Number 6, under the additional coverage property removed, the DP1 provides for how many days of coverage? Is it going to be A, 30, B, 45, C, 15, or D, none of the above? In this case, the answer is D, none of the above, because the time period is 5 days. Number 7, how much will the insurer pay for the loss of one tree from the peril of windstorm? Will it be A, $500, B, $250, C, $0, or D, 5% of the coverage A limit? So unfortunately, windstorm is not a covered peril for tree, shrubs, and plants under dwelling policies, and therefore C, 0 is the correct answer. Number 8, collapse coverage is going to apply to which form or forms? Is it going to be A, all 3 forms, B, DPs 1 and DP3, C, DP2 and DP3, or D, DP1 and DP2? In this case, collapse coverage is going to be covered under C, DPs 2 and DP3. Number 9, the peril of volcanic action is going to include all the following except. So what is not covered by the peril of volcanic action? Would it be A, lava flow, B, mudslide, C, ground shaking, or D, volcanic ash? So volcanic action peril will cover everything but C, ground shaking. That's only going to be covered by earthquake coverage. Number 10, additional expense is going to cover all the following except. So what will not be able to be covered by the additional expense coverage? Will it be A, the room rent, B, eating out, C, mortgage payment, or D, coin laundry? In this case, it's a normal payment. A mortgage payment would still have to continue to be made and paid and could not be recompensed under additional expense coverage under coverage E. All right, that's the end of chapter 6. Now we're going to move on to chapter 7, homeowners policies. So understand that homeowners policies is a comprehensive policy, personal lines insurance form that is used to insure residential risks. Right, so it's going to combine 3 different policies. It's going to combine a property coverage policy, theft of personal property, and liability coverages all in one policy. So the main difference between a homeowner and a dwelling policy is going to be the latter 2. Theft of the personal property is going to be mandatory here, and all liability coverage is going to be included, whereas liability was not included, or an option even in dwelling policies. There are same eligible policies that we talked about here under homeowners are going to be eligible due to their age, value, location. Under homeowners policies, it's going to be the same type of eligible property. So up to 1 to 4 owner-occupied residential units under one roof, properties under construction if they have an endorsement, insuring a tenant of a non-owned dwelling, mobile homes if endorsed, and seasonal dwellings and secondary residences. Again, not going to be able to cover farms under a homeowner's policy. There are 6 different coverage forms available under a homeowner's policy. The broad form is known as the HO2, and yes, you need to know all these broad forms and the coverage codes. HO for homeowners, 2. This is on a named perils basis only. It is a valuation on the structure for replacement cost value if to the coinsurance amount. The feature for a broad form is that this is the lowest premium available on a homeowner's form. Special form in HO3, this is going to be an open perils on the structure and the named perils on the personal property. Also at replacement cost value for the structure if up to the coinsurance ratio. This is the most common. Almost all homeowner policies are going to be in HO3 due to price. One thing to note about this is that wild animal damage is typically not covered under named perils, but it is covered under an open peril. So if you have a deer that busts through your door, the door getting busted up would be covered by the open perils coverage for the structure. But if the deer came in and messed up your couch or your flat screen TV, unfortunately, under a named peril, it won't be covered, and therefore you wouldn't have any coverage for that under your homeowner's policy if you have an HO3 form. The next form is called a renter's or tenant's form, commonly called renter's insurance. This is an HO4 form, and for the property is only going to be on a named perils basis and on an actual cash value loss assessment only. So all personal property under homeowners forms generally are going to be under an actual cash value only. The exception to that would be is if we're talking about a comprehensive form, HO5 form. This is an open perils form, and it will be on a replacement cost value if it is to the coinsurance value there. But I will tell you that this is an extremely high premium. Not very many people buy this because of the high premium, but this is by far the best coverage that you can get on a homeowner's coverage. If you happen to have a shared wall situation like a condominium or a townhome, a condominium form, HO6 is going to be the appropriate form for this. Named perils basis only on an actual cash value basis only for valuation. And then if you happen to have a historical home, this is typically used for these types of purposes on a modified form, an HO8. And this is going to have a named perils basis for the types of perils going to be covered and actual cash value only for the valuation of the losses. Just like we talked about under incidental businesses for our dwelling, you're going to have the same type of incidental business allowed under the homeowner's policy. The only thing that's different is you also have limited amount of liability that can be covered for the business, incidental business, but you can remove that with a special endorsement on your homeowner's policy. Now let's define out who's the insured here. The insured is going to be the named insured on the declarations page, including their resident spouse, also including any resident relatives, any non-relative residents that are there up to the age of 21. Any full-time students, whether they're living there or not, will be covered up to the age of 24, unless they're non-relative, and then only up to the age of 21. And then anybody for liability purposes, for somebody that is legally responsible for the insured's animals, watercraft, and some types of motorized vehicles, and of course the legal representative after the insured has died. So what's going to be covered? Where is it going to be covered? The described insured premise, anywhere that they're temporarily occupying that they don't own, like a motel room or an Airbnb or a vacant land, whether or not they're intending to buy or build on that property or not. Let's see here. Cemetery plots will be covered here under a homeowner's policy, including any burial vaults. And the occasional non-business rental of an area, like the rental of a wedding reception hall for your daughter or son, this would be something that could be covered under the homeowner's policy. So coverage amounts and types under homeowners policy on the deck page are going to look similar to the dwelling policy. There's one difference here under coverages. The indirect losses that would normally be under coverages D and E. Under the dwelling policy, coverage D is going to be combining D and E under a single category called a loss of use for all the indirect losses on homeowners policies. Coverage A is going to be the dwelling, just like it was on the the dwelling policy form we talked about before for a direct loss only. Coverage B is going to be for other or applicant structures. It is direct loss only. The standard amount is 10% of the coverage A base, but you can purchase additional amounts here, whereas you were limited to 10% on the dwelling policy. And coverage C is going to be for personal property, and there will be a standard amount, unaltered amount of 50% of the coverage A base. There are some insurance companies that will allow you to lower or increase this if you need to. Usually the range that I've seen is somewhere between 40 and 60% is about where they can put that coverage A base there. Now, one other thing to understand here about personal property under a homeowner's policy is that depending on the type of property for personal property and the type of event, peril, loss that occurs, right, there may be some special limits that need to be applied to the property in these cases, right? So whereas under a dwelling policy, you did not have any coverage at all for money, securities, banknotes, those kind of things, those are going to have a special limit of $200 for banknotes, bullions, coins, precious metals, and money. $1,500 is going to be the limit for all different perils for the type of property that is securities, accounts, deeds, evidences of debt, letters of credit, notes other than banknotes, manuscripts, passports, tickets, and stamps. $1,500 is a collective amount of coverage special limit for watercraft, trailer, furnishings, equipment, and outboard motors while on land. $1,500 is going to be the specific peril of theft for any jewelry, watches, furs, or precious and semi-precious stones. $2,500 is the theft specific peril limit for firearms. And there is a $2,500 theft specific peril limit for silverware, silver-plated ware, gold-plated ware, pewterware, flatware, hollowware, tea sets, trays, and trophies. Understand that all of those in that same category apply to the special limit. So the total of all that from a similar peril and event occurrence will be applied in those cases. Understand that those last three are only for the peril of theft. If they have another peril like a fire or something along those lines, those items would then be able to be covered to the full amount. And then another limitation that you have is there is a $2,500 limit for business property that is considered on premise, and $500 if that same business property is off premise, and that is an all perils situation for any type of loss. Understand that this one I learned that this was the case when I was an adjuster. I would be responsible for getting my own hotel room. So sometimes I would go on the cheap and get these hotel rooms that I didn't think were very safe and secure. So little did I know, but when I put the laptop back in the trunk, that was considered off premise of the rental car that I had. Instead of keeping it in the hotel room, I would have been covered up to $2,500 because that would have been considered on premise. All right. One thing to note here, typically doesn't come up because people that have secondary residences will keep separate insurance at those secondary residences. But if you have no separate insurance on that and you take something from your first residence to your other owned residence, you will only be able to be covered up to 10% of your coverage C limit. So don't take everything in the world with you when you go from house to house. Coverage D. This is going to work the exact same way that we talked about under the loss of use or indirect losses under the dwelling policy. So understand that that's going to have the same limitations that we were talking about there. Typical amount is going to be for 12 months on these payouts. Again, no deductible is going to apply on these because you've already suffered the deductible under a coverage A, B, or C limit. Now, other coverages, those that are covered along with the homeowner's policy for no additional charge, you're going to get those debris removal just like you did on dwelling policies. You're also going to have reasonable repairs. That property removed, alternate location coverage is going to be covered for up to 30 days from when you removed it from your property. Just like on our dwelling policies, you're going to get a fire department service charge recovered for you back up to $500. One thing that is new on homeowners policies is you do get credit card forgery and counterfeit money coverage up to $500 with no deductible. Understand that this is on a worldwide basis, and you can get this to cover your costs for these losses, but it can't be if it's covered already by the credit card itself, right? Lawns, trees, shrubs, plants coverage under a homeowners is going to be the exact same as what we talked about under the dwelling, up to $500 or 5% of the coverage A limit, and it's a limited perils coverage of fire, lightning, explosion, rider, or civil commotion, aircrafts, or vehicles. One unique thing that you're going to have on the homeowners is that if you have an HOA and you get a loss assessment from the HOA, just as long as it was coverable by your homeowners policy, you can get up to $1,000 covered by your homeowners policy for the HOA loss assessment. Grave markers and mausoleums are going to be covered up to $5,000 under a standard homeowners policy under other coverages. Glass breakage is going to be covered under a homeowner's policy. However, that will be suspended if the property is considered vacant. And they will allow for up to 10% of the coverage A limit if you have a building code update that increases the cost for the cost to recover from a loss. Now, to one of the things that is not covered by the dwelling policies, we're talking about liability coverages here in section 2 of the homeowners policy. So on the deck page, this is going to be coverages E and F. Coverage E is going to be for personal liability. This is going to cover bodily injury, BI, and property damage, PD, anywhere in the world to a third party, regardless of the negligence of the first party. There will be a $100,000 basic limit on here, and there is no deductible typically applied under any liability policies. This will include the insurance company having a duty to defend the first party, that's the insured, provide a defense, which means provide a lawyer and any of the other legal requirements. And in this case, because the insurer is the one paying for it, they can decide when or if they will settle out the claim. Under coverage F, this is medical payments to others. This is any of the necessary medical payments for expenses incurred within 3 years of an accident causing bodily injury to a third party without regard to fault. This can pay for the medical expenses up to and including funeral expenses if needed. However, the standard amount on this is $1,000 basic limit and no deductibles applied. You can buy additional amounts on both of these coverages if you would like, and usually they're fairly inexpensive to add up on these coverages. Additional liability coverages. So you will get the supplementary payments, like I said, which will pay for your legal costs, your lawyer, any expert witnesses, and it will recompense you for up to $250 a day for your lost income for having to go appear in court on the lawsuit in relation to your homeowner policy. Damage to property of others, up to $1,000 per occurrence. Say you borrowed your neighbor's Toro and you didn't see that big old rock in the yard and you just completely destroyed the $750 Toro. You can use your homeowner's policy to cover that up to $1,000 per occurrence to give the neighbor a brand new Toro because you just completely destroyed theirs. And then just like on a property loss assessment that you would get from an HOA, you can get a liability loss assessment from an HOA just as long as it would be coverable by your homeowner's policy. It can be covered under the additional liabilities here for up to $1,000 for your insured's share of the HOA loss assessment that they gave to you. So what's not going to be covered under a liability policy here, you're not going to be able to cover an intentional loss. One good thing here is that they do not consider any act of a child under the age of 13 as intentional, even though we know it may be. It is not considered by the insurance company nor the law to be intentional. Homeowners policies do not cover any lawsuits for personal injury, lawsuits because you've given a communicable disease. This could be as simple as the flu, syphilis, whatever, it doesn't matter. COVID, right? None of these communicable diseases will have coverage by the insurance company for you on that. If you or anybody in your household that was insured class had a bodily injury or property damage, you cannot be covered under the liability because liability only pays out to third parties. We talked about the business pursuits under an incidental business under your homeowner's policy. This is something that can be waived on the business pursuits exclusion here to where you can cover this with an endorsement or additional payment amount. Workers' compensation claims will not be able to be covered under your homeowner's policy, so it's important if you have somebody coming to do work at your house, if you can, make sure they're covered by workers' compensation. That is going to save you a lot of headache if somebody gets injured on your property. Because they're covered by other insurances that cover these exposures, aircraft and motor vehicle will not be able to be covered under homeowner liability. There will be no bailee coverage, right? Again, this is more of a business type situation, but you cannot have coverage for things that are in your care, custody, and control. Watercraft or contractual liability is also going to be excluded. Now, sections under for conditions of the property policy for the homeowners, the insurance duty after a loss. This is going to mirror exactly what we see on all property policies. You got to notify the insurer of the loss, make a police report if the loss is due to theft, protect the property from further damage, cooperate with the insurer, provide an inventory of the damaged property. Sometimes that's a little unique, but it is required because you got blanket coverage typically under your homeowner's policy. You do have to submit the proof of loss to the insurance company within 91 days in the state of Texas. And if possible, and this is just to make it easier process for the insurance company adjuster, is to separate out the damage and the undamaged property. Loss settlement vehicles for property conditions under HO2, 3, 4, and 5. These are going to be actual cash value for the personal property, but replacement cost value for the coverages A and B under those property forms, and that's going to be regardless only if it's to the insurance to value ratio or co-insurance has been met. HO6 and 8 is going to be actual cash value for all coverages A, B, and C. Selected conditions for liability under Section 2. There is a subrogation requirement that it must be in writing and prior to the loss for the insurance company to consider it to be valid. This means that you wouldn't be able to throw this crazy party and just come up with something off the internet that you have some people sign before they walk into the party that indemnifies you in case they get hurt on your property because of the party. This would be something that would have to be in writing to the insurance company ahead of time and prior to the loss, of course. Common conditions under both sections: declination, cancellation, non-renewal. Underwriting period for a homeowner's policy is 60 days. You can cancel by the insurance company in writing within 10 days notice for the following things: failure to pay premium, an increase in the hazard within the control of the insured that would increase the rates, or if there was fraud or the TDI requires it. A non-renewal on a homeowner policy does require a 30-day notice prior to the cancellation or policy expiration. When we're talking about homeowner endorsements, there is a ability to get a homeowner mobile home endorsement. The mobile home has to be on a permanent foundation. The axle wheels removed. You can get an earthquake endorsement to cover the ground-shaking earth tremors. This would cover any damage within a 72-hour period to be considered one occurrence or only one deductible applying in that case. Homeowner endorsement, you could get the permanent and incidental occupancies. This is buying back of the incidental business exposures under your liability. And then if you have property that would be subject to those special limits, you could take them out of the blanket coverage under coverage C and put them under scheduled personal property with under the same homeowner endorsement. Or you could put as a separate policy attachment to the homeowner policy, you could get what's called a personal article floater. We'll talk more about those in Chapter 12, Inland Marine Insurance. Watercraft liability policy is an endorsement that you can put on your homeowner's policy. I don't recommend it, but it is possible to put liability coverage for watercraft on your property policy for the homeowner. Separate watercraft policies are more appropriate for the watercraft, in my opinion. If you have a personal watercraft, this is the most common. It has to be less than 26 feet in length and have no commercial use. And that one is going to be the most common and the least expensive. Yacht policies, I hardly see these because it's a larger boat, anything larger than 26 foot, but it has no commercial use. Usually these larger boats tend to have some kind of tax advantages to the person that owns it, so they will usually have some kind of a commercial use associated with those larger boats. Marine policies are going to be for any boats that's used in a commercial capacity for any reason. So this is more typical for the larger boats. And then you can get a separate liability insurance policy only under your homeowner's policy. That's called a protection and indemnity plan, a P&I plan. And this is just the standalone version of that endorsement that we were talking about for watercraft under the homeowner policy. All right, so let's do a review of the questions under the homeowner section, and then we will wrap up this section. All right, so number one, Mary purchases an HO3 form for a home that has $300,000 coverage limit on the dwelling and $150,000 for personal property and a $500 deductible. If jewelry valued at $20,000 is stolen from the dwelling, Mary will collect a maximum of which of the following amounts? Right. So in this case, because the peril is theft, right, then she would only be able to be covered for up to $1,500 in this case because of the special limit applying to jewelry. Number two, John insured his home with an HO3 form for $200,000. If he had a fire loss of $25,000 for his unattached garage, his standard homeowner's policy will provide coverage for which of the following amounts? A, nothing, B, $10,000, C, $20,000, or D, $25,000. The answer here is C, $20,000, because the standard amount, which is the key in this question, is 10% of the coverage A limit, which is 10% of $200,000 or $20,000. Number three, the homeowner's form that provides open perils coverage on both the dwelling and personal property is going to be A, the HO2, B, the HO3, C, the HO5, or D, the HO8. Open perils on both the dwelling and personal property is going to be on the HO5, C. Number four, the following items were stolen from a homeowner. Which of these losses would be fully covered under coverage C of an HO2 policy, assuming that the deductible had been satisfied? A shotgun and rifle valued at $3,000. B, a $2,000 computer the insured uses in an in-home accounting business. C, a $4,000 mink stole, or D, a $3,000 silverware set. In this case, the only one that could be covered because special limits would apply to the rest would be B, a $2,000 computer the insured uses for an in-home accounting business. Number five, Susan owns a condominium. Which homeowner's form must she buy? Will it be A, an HO6, B, an HO3, C, an HO5, or D, an HO8? This is going to be A, an HO6 form for the condominium. Number six, which HO form provides broad name peril coverages on coverages A, B, and C? Would this be the A, the HO8, B, the HO3, C, the HO2, or D, the HO5? In this case, this is HO2, broad name perils basis on coverages A, B, and C. Number seven, under the HO forms, full-time students who are related to the named insured are insured up until which age? Is that A, 18, B, 25, C, 24, or D, 21? So this is going to be C, 24. Number eight, the insured suffered a fire loss for her personal property while staying at a hotel in Madrid. Her HO3 policy provides $100,000 of coverage for personal property with a $500 deductible. Assuming her loss was $110,000, how much will she be paid? A, $99,500, B, $10,000, C, $50,000, or D, $100,000. In this case, D, $100,000 is the correct answer. The reason for this is a total loss because $110,000 is greater than the $100,000, so it's greater than the actual cash value. So it's a total loss, and it's due to the peril of fire. So therefore, no deductible applies, and $100,000 would then thus be the correct answer. Number nine, a deer jumped through the front window of a home insured with an HO3. What property is going to be covered? Is it going to be A, both the dwelling and the personal property? C, just the dwelling? C, just the personal property? Or D, nothing? In this case, because it is an HO3, just the dwelling is going to be covered because of the wild animal damage. And number 10, the HO homeowner liability coverage will pay and defend for all the following except. So the homeowner liability coverage will pay in all these situations but one. Which one will it not pay in? Will it be A, the insured's 12-year-old son intentionally breaking the neighbor boy's bike? B, the insured's dog biting a stranger? C, the insured tripped and injured an old lady while vacationing in Rome? Or D, the insured told a neighbor that the landscaper stole something and then the landscaper sued for libel? So personal liability is not going to be able to be covered under the homeowner liability standardly. So therefore, D is the only one that's not going to be able to be covered by the homeowner liability. The insured told the neighbor that the landscaper sued. All right, that's everything for chapters 5, 6, and 7. Homeowner's policy in this case. We will be continuing on to personal auto next.